Now, the head of Wall Street's biggest lobbying group says derivatives markets need an empowered regulator. Tim Ryan, head of the Securities Industry and Financial Markets Association, says regulators need adequate data on private trades to monitor risk. He was speaking at a panel discussion. Dealers have been moving the most actively traded contracts to a central clearinghouse and will soon start reporting all interest rate swaps and equity derivatives. The aim, of course, to avoid the unforeseen counterparty risk exposed when AIG and Lehman collapsed last year. The Bank for International Settlements says the gross market value of over-the-counter derivatives at the end of last year was almost $34 billion, and the total outstanding notional value of those derivatives was just under $600 trillion. Two-thirds of that was interest rate contracts. Toby Lawson is Managing Director and Head of the Hong Kong unit of New Edge, the second largest US futures brokerage and the biggest broker for listed futures here in Asia. Very good day. Thanks for joining us today. This debate, as it goes on, I'll give you a quote from the US Representative Paul Kanjorski, who says the clearing of most products, not all, through a central clearinghouse seems appropriate and should not impose an undue burden. Meanwhile, the Senate Agriculture Committee Chairman Tom Harkin says the OTC derivatives market has to go to a regulated exchange. Which is the better solution, do you think?
I think the former is probably the better solution. And what we're talking about here is really a transition that happens anyway within the financial markets. What you've seen, particularly in OTC products, is clearly with the collapse of Lehman and the demise of AIG, there was a huge populist outrage towards credit default swaps because they weren't centrally cleared. And the argument being that if you netted down and had a centrally cleared CDS market, you would end up with about a $5 trillion exposure as opposed to a $28 trillion notional exposure. So on that basis, the move towards central clearing is the fair argument. And that allows you to diffuse the risk from a default for an issuer like AIG, for instance. So that Kanjorski's argument's probably sound. To take it to the next step is to exchange trade, to standardise all of the OTC products onto an exchange is less of an argument. And the reason that is because those who actually provide liquidity, the banks, the interdealer banks who are actually pricing these products, need to have a certain risk return. And being off-market and being able to negotiate that allows them to get that risk return, to assume the risk and to manage that risk. The buy side also like to sometimes have non-standardised approach. They need to hedge specific risks. And as a result, if they have to go onto an exchange, they have more basis risk. They might get more transparency, but they'll have basis risk. So I think the clearing counterparty direction is normal and should be continued. But in terms of moving it onto exchange traded, I would argue that that's probably a step too far. OK, well, I mean, the International Derivatives and Clearing Groups and the International Swaps and Derivatives Association both say if you force them onto exchanges, the US will lose business. It'll basically go overseas. Would you agree with that? I don't agree with it 100%, because I think that what's happening is governments and regulators are working together globally to come up with a solution. What they don't want to see is this systemic risk appear again in OTC derivatives. So it's probably self-empowering to say, yes, look, we'll lose business to avoid having oversight and increased regulation. But I would assume that European regulators, Asian regulators are going to follow a very similar line to the US. And as a result, I don't see that as an argument to lose business just because the US are going to go down one side too hard versus the Europeans. This is the point, isn't it? I mean, Asia's watching at the moment, but I mean, the US is so big in the derivatives market. Basically, what the US does, it's one of the counterparty risks in so many of the deals. Asia's going to have to follow suit. How is it affecting your business as a listed futures broker in Asia? Oh, it's very good for us in so much as if the market trends towards listed, it's our bread and butter. And but is that happening right now? Are you picking? It is. What we're seeing more activity in listed futures and options across asset classes. There's no doubt, and there's two reasons for that. Firstly, of course, the Novation Protocol allows for people to want to go on and get that counterparty risk reduced. But secondly, a lot of the interbank dealers on the OTC market are really not as active, particularly here in Asia, because the banks who are mainly headquartered offshore are not delivering as much capital to play in this game. So what you're finding now is the buy-side players have to go to exchange. They increase their basis risk, but they get more transparency. So from our perspective, that's a good thing. But from a New Edge perspective as well, we've been developing that interdealer space for the last 5 years because we see OTC to listed as a normal progression. It's accelerated now because of the crisis, but essentially we've got good businesses already in the interdealer space, should I say, in equity derivatives, in commodities, as well in credit default swaps here in Hong Kong. So we're comfortable with where the market is, we're comfortable with where it's heading, and we're excited by the opportunities that presents.
Are you actually investing to expand your execution services and your trading platform?
Yes, because in the end, not all products will be exchange-traded and electronic. That transition process across product will differ depending on the liquidity, the amount of counterparties, the complexity of the transactions. So we want to be there at every step of the transition, if you will, to the end game, which is where our strength is.
OK, one final point on the derivatives market as a whole. Of course, it got a bad rep last year, and we saw a decline in volumes across all asset classes. We've seen a big pickup in equity markets generally. Are you seeing a pickup in derivatives trades?
Derivatives trades on the OTC side, not so much, but if derivatives are as defined by listed futures and options, yes. Across assets, I think you'll see equities continue. People have to invest cash at some point. Derivatives will continue to be a key functioning element of the financial markets. I see across the asset classes further development in the energy space, and in particular environmental derivatives. I think this is an area where once the financial crisis sort of dust settles and people start focusing back on global warming, for instance, we're going to see a big development of OTC product in environmental derivatives. And in fact, in Australia, New Edge has already dealt some carbon emission reduction units before the government has even issued its regulated scheme. So we're going to see a lot more of that, and I think it's going to be a very interesting area for the business again. OK, Toby, thank you very much indeed for your time. Toby Lawson, the Managing Director and Head of the Hong Kong unit of the futures broker New Edge.